Welcome, everyone. Today we're covering Chapter 10, Flexible Budgeting and Variance Analysis. This chapter is extremely important because it teaches us how businesses evaluate performance. We learned in Chapter 9 how to build budgets. Now we're going to learn what happens after the budget is created. Managers compare actual results to budgeted expectations, compute variances, and then investigate why those variances occurred. Variance analysis is one of the strongest tools for identifying inefficiencies and improving cost control. By the end of this chapter, you should be able to identify cost variances and explain why they are favorable or unfavorable. Prepare a flexible budget and compare its usefulness to that of a static budget. Describe the concept of standard costing and its advantages and disadvantages. Summarize how standard costs are developed and computed. Compute and explain material and labor variances, and compute and explain manufacturing overhead variances. These objectives cover the full variance analysis process used by businesses. Before we jump into business budgeting, let's connect variance analysis to a real-world example. This slide compares E85 ethanol gasoline to regular gasoline. E85 is usually cheaper per gallon, but is also 20 to 30% less efficient. So even if EA5 has a lower sticker price, the total cost per mile driven may actually be higher. This is similar to variance analysis in business. A lower cost is not always better if efficiency declines. Managers must look deeper than the surface numbers to evaluate performance. This slide reminds us of a key budgeting concept. Good performance analysis starts with a baseline, the budget. Budgets provide the standard that managers compare against actual performance. Without a budget, managers have no benchmark for evaluating whether costs are controlled or whether production is efficient. Now complete learning activity 10.1. The items listed are part of the operating budget process. You are asked to rearrange them into the correct sequence. Remember, budgeting begins with sales because everything depends on projected sales volume. Then production is planned to meet sales demand. Then the cost budgets are prepared, and finally the financial statements are projected. Pause here and complete the activity. Once you finish, check your answers with the solutions provided in the back of Chapter 10. Now we begin learning Objective 10.1. A variance is the difference between what we expected and what actually happened. Cost variances are the differences between budgeted costs and actual costs. Managers compute variances to evaluate cost control and identify inefficiencies. However, simply computing a variance is not enough. Managers must analyze variances and identify the root cause. Variances are classified as favorable or unfavorable. A favorable variance means actual results created a higher profit than expected. This can happen because costs were lower than expected or revenue was higher than expected. An unfavorable variance means actual results created a lower profit than expected. This can happen because costs were higher than expected or revenue was lower than expected. Notice that favorable does not always mean good, and unfavorable does not always mean bad. Managers must interpret variances carefully. Variance analysis is the process managers use to examine variances and determine the underlying cause. This involves identifying whether the variance is caused by price differences, efficiency differences, waste, or changes in volume. Variance analysis is essential for continuous improvement. The goal is not just to identify differences, but to learn from them and improve operations. Now complete learning activity 10.2. You're given scenarios and must match each scenario with the correct type of variance. For example, paying more than expected for raw materials is an unfavorable price variance, where using less raw material than planned is a favorable quantity variance. Pause here and complete the matching. Once you've finished, check your answers with the solutions provided in the back of Chapter 10.